Last class period, we started discussing the issuance of a bond. Remember, a bond is a contractual agreement that allows an investor to receive a repayment of principal and interest in exchange for giving money up front, sort of like a loan. However, a bond is issued in smaller dollar increments to many investors, as well as it has an established market for the investment to be traded upon. When looking at a bond, remember that we outline several components that are important to our calculations. For instance, the stated interest rate, the face value, as well as the maturity date. In addition to what's actually quote unquote printed on the bond, we also considered things like the market rate of interest, which is the rate demanded by investors for this type of investment. Because the market rate and the stated rate don't always equal, bonds can issue at a sales price above the face value, which is known as a premium, a sales price that's equal to face value, which is known as face value, and a sales price that is below face value, which is known as a discount. Notice that when we issue at a discount, the market rate demanded is higher than the stated rate provided. When we issue at a premium, the market rate demanded is less than the stated rate provided. And when we issue at face value, the market rate and the stated rate are equal. Because there are three scenarios in how bonds can be issued, we have three scenarios in how we journalize the issuance of the bond. If a bond issues for face value, we debit cash and credit bonds payable for the sales price or the face value, because the sales price and face value are equal when a bond issues for face value. If we have a discount, the cash that we receive is equal to our sales price of the bond that is no longer the same as face value. It is less than face value. The bonds payable is credited for face value, and the discount is debited for the difference. With a premium, we have the sales price as the debit again, the bonds payable as the face value, and the premium for the difference. Notice in all three circumstances, bonds payable is always credited for face value. Notice that also cash is always debited for sales price. It just so happens that in the face value issuance, face value is equal to sales price. Finally, note that the first journal entry we do, the issuance, when we debit cash, this becomes the bond's carrying value initially when we are determining what shows up on the balance sheet. The carrying value, remember, will be, if it's a premium, bonds payable, the face value, plus the premium on the bonds payable. This will equal carrying value, what shows up on the balance sheet. At face value, there is no premium or discount, so the carrying value is simply the face value of the bond. And with a discount, the carrying value is bonds payable minus the discount, and this becomes our carrying value. Again, the issuance price, the cash we receive in the first journal entry, that is the initial carrying value, but it will change as we do subsequent journal entries, which is what we'll look at right now. The next event in the life cycle of a bond would be interest. To record interest, we again have three separate scenarios. The first one is for face value issuance. Here we simply debit interest expense and credit cash. I'll tell you how we get the amounts here in just a minute. Under a discount scenario, we're not only debiting interest expense and crediting cash, although we do that, we are also going to credit the discount to reduce it over time. And I'll talk to you about why here in just a minute. And finally, under the premium scenario, we're also going to debit interest expense and credit cash, but we also need to reduce the premium, and so we're going to debit the premium over the life of the liability. Remember, in reducing the discount or premium over the life of the bond, we are essentially changing the carrying value. The carrying value for a discount will work its way back up to face value, and the carrying value of a premium will work its way back down to face value. The idea is that when you issue a bond at a discount, you are charging less for the bond than what you pay back as face value. So for instance, if we issue the bond for $90,000, but it has a face value of $100,000, we're going to be paying back $10,000 more in principal than we actually got to borrow. This is how we help the investor actually get the interest rate demanded by the market. Essentially, we issue at a discount because our interest rate is lower and the market demands a higher interest rate. So instead of changing our interest rate, we simply take less cash up front and pay back more as principal at the end of the bond. And so our amortization of the discount by crediting here actually increases interest expense. You can see that the combination of the discount and cash is what combines to give us interest expense. So the amount of cash we pay in interest is less, but the combination of the amortization, the reduction of the discount, and the cash paid sums up to be the total amount of interest expense, which ends up being then more than the actual cash paid for interest. In order to determine the amounts that go in the journal entries for recording interest, we use what's called a bond amortization schedule or table. In this, we have several columns, but understand very quickly that these columns, cash paid, relate to the amounts that we're actually recording in our journal entry. Interest expense relates to the amounts we're recording in our journal entry. In the example we're going to look at right now, it's a premium amortization table. I'm circling the items under the journal entry for the premium column. However, this would work the same way, very similar in doing an amortization schedule for a discount as well. So the last column here is the premium amortization, and that corresponds to this piece. Notice that we identify that right here as the journal entry components. We then use calculations on the right-hand side to continue the process year after year after year. Cash paid is going to be calculated as the stated interest rate multiplied by face value. Now, we would adjust for time, but most of these amortization tables you'll be dealing with are just annual interest periods. So multiplying by time would just simply be a multiplication of 12 over 12, so we can exclude that. So essentially, cash paid is always going to be stated rate times the face value. So notice how all of these are exactly the same. Interest expense is calculated by taking our carrying value during the previous period. So we'll call this carrying value T minus 1 multiplied by the market rate. That's how we calculate interest expense. So essentially, the interest expense calculated here for the 4290 was the previous carrying value that we had, 107,260, and multiplied by whatever the market rate is. Notice that that starting carrying value right here actually comes from our initial sales price right here. So that's where we pull that from initially. You can see that the next column, column C, is calculated by taking our previous two columns and calculating the difference. And I like to say these differences are in absolute values. And the reason why is because if you're doing a premium rate, it's going to be A minus B. But if you're doing a discount, it's going to be B minus A. So in order to not remember which one comes first, simply just take the absolute value. And that's how you calculate the amortized portion of the premium or discount. Remember that these amounts right here make up our journal entry that's going over here. Then the subsequent columns, bonds payable is always a static amount. It's the face value of the bond. The premium on bonds payable is the starting difference. Remember that this is going to come from your initial difference here. That's where we get this. And that difference is reduced by the amortized premium. So we have 7,260, which is reduced by 1,710, and that becomes 5,550. Notice that these two are summed together, that's told to us right here, to produce our carrying value. And that makes sense. That's the carrying value that we calculate up here on the bond issued at a premium. It is the bonds payable face value plus the premium. Notice if we had a discount instead, it would be the bonds payable minus the discount to equal our carrying value. So you just change the table slightly. The final journal entry for the life cycle of a bond will be the retirement. If a bond retires at the end of its life, then the journal entry is simply debit bonds payable and credit cash, regardless of the scenario. It doesn't matter if it's a premium, a discount, or a face value. It will still be debit bonds payable and credit cash because the premium and discount accounts should be amortized away at that point. However, if we have early retirement, we could have a scenario where we have a gain or loss on the retirement of the bond. and we would have to remove any premium or discount associated. So, for instance, we could have a scenario where we have a loss. Let's say we debit bonds payable and credit cash. And if we have to pay more than what the face value is of the bond, then at that point we would have a loss. Could also have a scenario where it's a gain. That would be if we pay less. These are an either or right here, not a both. So they won't be both, but they could be either or. But the other piece is that if you have a premium or discount, you'll have to get rid of it. So if you have a remaining premium here, you would debit the premium. If you have a remaining discount, you would credit the discount. Again, these are an either or none scenario here. It's not going to be both. So if you have issued at face value, you won't have a premium or discount to get rid of. And if you issued at a premium, you won't have a discount. If you issued at a discount, you won't have a premium. And again, same way with the loss. It's an either or none. You don't have to have a gain or a loss. But if you do have a gain or loss, you're not going to have both, right? You're either going to have a loss or a gain.